We're going to work on Linda's first month of business. This is a cumulative exercise that kind of brings together all the chapters so far. So let's record these transactions. Let's do any journal entries that are needed, any adjusting entries, and let's do the financial statements. All right, let's start. Owners contribute $20,000 cash. Okay, so that's an increase cash and increase owner's contribution. So that would be a debit to cash and a credit to stock. Buy 10,000 inventory on credit, so we're not going to write a check because we're going to buy it on credit. So inventory would go up and we would owe the vendor for that, so that would be debit to inventory, credit to accounts payable. Notice here I'm just showing positive and negative to know if the account's going up or down, and then we would have to review debits and credits to know whether we need a debit or a credit to get that movement of increase or decrease. Okay, so now we're going to sell 60% of the inventory. So here we have 10,000 inventory. We're going to sell 60% of it. Okay, and that's going to then become cost of goods sold. And cost of goods sold is going to reduce retained earnings. So now the accounting equation is still in balance. Negative equity, negative assets. All right, and we're going to record the sale, and it was sold on credit. So we're not going to get the cash. We're going to get a promise to pay you later, and we have a sale. Sometimes students forget to record the revenue, that you did the thing for the customer. They know to remove the inventory, and then they kind of stall out. So you would definitely want to record the that you did the thing. All right. What's next? Transaction 4, customers pay. Okay, now we're going to get some cash. Now we're not going to record revenue when we get the cash. We recorded revenue when we made the sale. And so later when we collect, we just cancel the IOU. We cancel the accounts receivable. Okay, let's pay the vendors for half of the inventory. All right, so here's where we bought the inventory. We owed the $10,000. We're going to pay half of that. I'm going to write a check until we're not going to owe the whole thing anymore. So that's going to reduce cash and reduce liabilities. Okay, transaction 6, pay this month's rent, utilities, and supplies. All right, write a check. And we've got rent expense, supplies expense, utilities expense, and expenses reduce retained earnings. Should have made sales increase retained earnings there. All right, transaction 7, pay for 6 months of insurance. Okay, so we're going to write a check. That'll go into prepaid. Okay, and now what needs adjusting? That prepaid needs adjusting. There's 6 months in there, but now 1 month has expired, the first month of business. And so that insurance expense of $200 needs to be recorded, and expenses reduce retained earnings. And now I'm ready to do my financial statements. There are no other adjusting entries. I don't have any unearned revenue. I don't have any expenses I need to accrue in. I don't have any billings that I need to accrue in. I don't have depreciation on long-term assets. I don't have a loan I need to accrue interest on. So there's sort of a collection of 8 or 9 classic adjusting entries that we want to watch for and scan for, but this particular firm just has that one. All right, well, that's the deal. So let's get the balances now in these accounts. And we'll do our financial statements. Okay, so the balances in the bottom here are the balance sheet. This column here is the cash flow, and these 2 columns here are the income statement. Why don't you freeze the frame and see if you can create those financial statements. So here's the balance sheet. We've got the cash and the accounts receivable, the inventory, and the prepaid, adding up to $38,800, and then we've got the balance in accounts payable, the stock account, and the retained earnings. So that adds up to the $38,800. For the income statement, we've got that one sale, and we've got the cost of goods sold, and we've got the rent, utilities, and we've got the insurance expense, getting us down to the profit of $13,800. And for the cash flow statement, we got $1,600 from customers. We didn't collect the whole 26. And we made payments to vendors and employees. What are those? So those are the payments for inventory. Those are the rent and utilities and the prepaid insurance policy. Those are all payments, even though they weren't all expensed, because some is still suspended in prepaid. There were no purchases or sales of long-term assets or investments, and there was one contribution with transaction with the owners. And so that's the net cash that changed during the period, and that's ending cash because we did start with zero. So our cash flow statement does show everything.